Good evening, everybody, and welcome to the Pensions Committee and Board. I'm Councillor Yvonne Say, and I'm Chair of the Pensions Committee and Board. Please note this meeting is recorded by the Council for live and subsequent broadcast via the Council's internet site. I'll begin the meeting by asking members to introduce themselves. So can we start with the councillors? Councillor Bevan on my left.
Councillor John Bevan, Northumberland Park Ward Vice Chair.
Matt White, Councillor for Tottenham Central.
Councillor Tyain Curran, Woodside member.
Councillor Hymas, St Anne's Wood.
And can we introduce the other members? And officers? Shall I start with you?
Good evening, everyone. I'm Josephine and I'm the Assistant Director of Finance.
Sorry, Tim, do you want to go next?
Good evening, everyone. My name is Tim Impofu. I'm the Head of Pensions and Treasury.
Evening, Jamie Abbott, the Pensions Manager.
Fiona Ray, Principal Committee Coordinator, Clerk to the Committee.
John Vazen, Independent Advisor.
I'm Julie Bailey, one of the Fund Actuaries from Hymans Robertson.
Douglas Green, another Fund Actuary from Hymans Robertson.
And we have Patrick joining us from joining virtually.
Good evening, everybody. Patrick Hughes is Legal Advisor to the committee.
And who's the man with him? Oh. Do you want to introduce yourself?
I'm David Eagles. I'm the External Audit Partner from BDO.
Oh, lovely, thank you. Item 2 on the agenda is apologies for absence. We have none and received none. Sorry.
Apologies for the lateness. Randy Plowright from.
Hi, nice to see you, Randy. Item 3, urgent business. There are no items of urgent business. Item 4 is declarations of interest. Are there any? Has anybody got any declarations of interest or conflicts of interest to declare? No? Okay. We'll continue then. Item 5 is deputations, petitions, presentations, questions. And can I invite the deputation to come and sit at the table, please? Thank you. We've received a deputation request from Anita Chandler, Haringey Unison and Environment Rep for St Aidan's, and Mark Lancaster, Haringey Unison Acting Chair, on divestment from fossil fuel companies. The deputation spokesperson will have 3 minutes to address the Pensions Committee and Board. Following this, the Pensions Committee and Board can put forward questions to the deputation party. There will be a maximum of 15 minutes for this item. I now invite Anita Chandler to speak to the Pensions Committee and Board for 3 minutes.
Thank you. Is that loud enough? Thank you. So, as you may well know, Unison was the first national union to pass a formal divest motion, and on the back of that, Haringey branch passed a motion to encourage Haringey Pensions Committee to divest from the carbon-based economy back in spring of last year. That motion was submitted by our branch secretary, not through a deputation, I believe, to this pension committee. We still await a response. So this request for deputation is part of that request for a response, and it also builds on the good work by Friends of the Earth local groups who've had 2 deputations here in 2020 and 2016, particularly with Quentin Given, who some of you may know. So what is it that we're looking for now? So I'm going to try and run very quickly through this, because it's very hard to say what I want to say in 3 minutes. What we would like to see is, number 1, a report on the current fossil fuel exposure and to explain why this has increased despite the RAFI claim that it was due to go down by 7% annually in its carbon intensity, and we've seen that it's gone up. A report on your investment strategy review, including carbon footprint, and particularly on the impact of your engagement strategy and how both of these will inform future investment decisions. We argue that the public interest in disclosing this information outweighs the public interest in exempting this information, particularly as I'm a member of this fund and would like to know. We would like a survey of the members of the fund for their views, as has been done in other councils. And we would like, ideally, a motion to divest the rest within 3 years, as is happening across other pension funds within Europe, to make it public and outline steps to achieve this. Lastly, reinvesting actively locally in green and reporting on your current green investments and publicising them, particularly if they are within the UK or near to the UK, as onshored, if you like, reinvestments. We do want to commend you for what you've done so far, because actually what you've done so far is pretty brilliant. And a lot of councils have not done as much as you have done, but they claim that they are. You've just divested from all the direct investments, but you haven't told anybody about it, which in many ways is good for us and a little pat on our back, but it does absolutely no good in the global picture of creating change. Social, silent divestment has very little impact, particularly as is reported in your minutes that you are, or we are, LGPS, are low volume shareholders. So in the fossil fuel picture, it's not very much. That's why you don't get the votes in favour of the LAPF, because you don't have the money to actually swing things. So silent divestment isn't cutting it. It needs to be public. It needs to effectively name and shame the fossil fuel companies, because it removes their social licence to operate in that way. And it then encourages the government to see that people are behind this, and they need to be seen to be doing something too, to legislate to reduce demand and supply. So that is the whole point of public divestment, and that's why we want to see the council doing it within a given time frame.
I'm sorry, your 3 minutes is up.
Oh, well, that was quick. I only got to point one.
Sorry about that.
Ask me about fiduciary duty then, and I'll answer on that one.
Thank you for your comments. Before I open this up to questions from the Pensions Committee and Board, I'd like to say a few words about the significant steps the Pension Fund has taken to reduce the carbon footprint of its investment portfolio in recent years. Since June 2021, all of the Pension Fund's list equity allocation has been invested with sustainable low carbon funds. This included being one of the first investors in the Paris-aligned RAFI Multi-Factor Climate Transition Fund, which targets annual reductions in the carbon exposure. In addition to this, the pension fund has committed approximately £130 million to renewable infrastructure funds that invest in various renewable energy projects, including solar and onshore wind. We are happy to provide more details on these projects as part of a written response to the deputation. I believe I speak on behalf of the Pension Committee and Board in voicing our commitment to making sure that the pension fund invests its funds responsibly. To support this commitment, the fund has been a long-standing member of the Local Authority Pension Fund Forum, LAP, and we regularly instruct our investment managers to vote in line with their recommendations. This has formed a key part of the fund's engagement strategy with the wider investment community. LAP has been the leading voice within the investment community on working to protect pensions against climate risk. We'd be happy to provide more details on the work LAP has undertaken on the fund's behalf as part of a written response to this deputation. Undoubtedly, there's still a lot more work to be done. We plan to review our investment strategy in detail in the upcoming months. With that said, are there questions from members of the Pensions Committee and Board to the deputation party? Councillor White.
Thanks, Chair. Thank you very much for your deputation and for your kind words about the work that we've been doing. Obviously, it's really important that groups like you are holding our feet to the fire on this kind of issue. You said you only managed to make 1 point of 3. What were the other 2?
To comment on the engagement strategy, success or failure, is there time, is it working, can we escalate it? Because looking back through the last 3 years of your minutes and the last 3 years of the LAPFF reports, I would say by far the majority of climate related voting alerts have gone very much against the recommendations of the LAPFF. In fact, even some members of your board here have commented on this in your minutes and have raised concerns about it. The response has been, well, we don't have many shares effectively, so it's quite challenging to win a vote. So my question would then be, well then, is it effective, your engagement strategy? Is it actually working? Is there's time? I note that one of the Dutch public health funds, they actually said that they are planning to divest within 2 years, so they have made it public. They have given a time frame. So they've given what they've called an escalation strategy. There's another, I think it's ABP or ADP, one of the world's biggest pension funds, also Dutch. They have actually publicly admitted that their engagement strategy has failed. And that there isn't time to do any more with it. And I'm going to quote you that one. This is the chair. We part with our investments in fossil fuel producers because we see insufficient opportunity for us as a shareholder to push for the necessary significant acceleration of the energy transition at these companies. So they're basically saying engagement's not cutting it. It's time to divest. And we would argue that your engagement strategy should include an escalation aspect. I don't see as a member, I've never seen an engagement strategy. All I see is things about papers and letters and votes happening, nothing else. I don't see timelines, I don't see objectives, I don't see targets, I don't see what next if it doesn't work. What these companies have shown, these pension funds in Holland have shown, they've decided what to do next if it's not working. And divestment is part of their escalation strategy. In fact, the government in 2021 produced the greening report, greening finance report, where it very specifically says the exercise of stewardship discipline may eventually escalate to withholding capital or divestment. For example, where a company is not taking appropriate action to transition to net zero. So there's our government saying that divestment is a good part or a reasonable part of an escalation strategy, of an engagement strategy. So can we see some of that, please, in whatever you're producing? Because as I see it, you are engaging, but I don't see any outcomes if you don't have this sense of what you want to achieve and what you do if it's not achieved. Saying it's happening is not an effective strategy as far as I'm concerned. That was my main point on engagement. My other points were on fiduciary duty. Very short, you all know that fiduciary duty is now a double-edged sword. It can be used as an excuse to carry on investing in fossil fuels because the returns are very good. However, we now have the FT, the MSCI is the index, one of those big world indexes, saying that over the last 10 years, fossil-free funds have outperformed the standard fossil funds that include oil, gas and coal over 10 years. Not in the short term, but over 10 years. So there's a good reason to say that fiduciary duty suggests you should be divesting. You should be divesting as well for younger members. You have to treat them equally, fairly as between them. Stranded assets is a big risk. Are we going to have claims for discrimination coming down the line, that the needs of the current pensioners like my good self in 2 years' time, my returns are being put ahead of the returns of any younger member? Is this discrimination? Could there be legal cases against you for this? And my last point on fiduciary duty is, I'm sure, as you know, Client Earth are trying to take Shell to court for a failure in their fiduciary duty to their shareholders for their climate risk mismanagement. And this is so strongly supported by the London Collective Investment Vehicle, of which Haringey is a part. So if you're a part of this vehicle, it's basically saying engagement has failed, so we're taking these guys to court because they are not managing the fiduciary duty to their own shareholders to manage risk effectively. That's something that I think that our council should be looking at. So my last little bit was, can you divest and reinvest green and publicise where you've invested green, particularly if it's local? Let us know what's going on there, because that's all good. That's all in line with your Haringey Climate Action Plan. And we really love to see that, you getting publicity for doing all those right things. I think I've got everything in now. Thank you, Matt.
Councillor Inge, Karen.
Thank you, Chair. And Thank you, Anita. Thank you for coming here and with your deputation. I want to second everything that Councillor White has just said. I have a question with regards to the third point you've made here, adopt a target to divest the rest within 3 years. May I ask you to expand a little bit more how you've chosen that number, 3 years?
Wait, two ways. One, it gives you a bit of time to think about it. Secondly, ABP said they were parting with their investments. This is one of the world's largest pension funds. 15 billion in 2 years they thought they could manage. So I reckon you've got 30 million still exposed to fossil fuels. I reckon that giving you 3 years, 30 million, when they thought they could do 15 billion in 2 years was reasonable. So really, there's nothing particularly scientific about it. It was just a reasonable length of time.
Councillor Hymas.
Yeah, thank you so much for your deputation, really informative. My question is, like, as a committee, where do you think we should be looking for green investment strategies in terms of other councils? I know you said Haringey is doing well, but where would you say is best practice that perhaps officers could go and speak to design this strategy going forward?
This is not something that I know huge amounts about, because I don't see it as my role as being a pension advisor. I think you have plenty of pension advisors that you pay lots of money for to get good advice, and they know what green funds are out there. All I can say is what other places have done. Munich, for example, I know not the UK, they have solar panels and wind farms in the North Sea and solar panels in Wales, is it? And they use the profits from those to run their public services and their libraries and their swimming pools back in Munich. So it's not always possible to invest your own pension pot into your own area. I gather that there might be conflicts of interest, because you might start budgeting to say, oh, well, we don't need to put any money into that because we can use the pension instead. So I know there can be a conflict of interest in investing right in your own borough, but you've got other boroughs near around that you could be working with to look at ambitious plans for London about solar panels on reservoirs or whatever, or wind farms around the edges, because you've got Hackney and places like that. There's social housing, there's a lot of that. Please don't go looking at all those airports that are putting their names out into the Financial Times yesterday, saying they wanted to expand hugely before the environment groups got in on them and said that it wasn't good. We really don't want more airport infrastructure. So it's things like social housing, particularly renewable energy, local energy, supporting local community groups as well, developing their own energy, because there is the local electricity bill going through Parliament at the moment, which allows local groups to, even a street, to set up, generate and sell electricity locally. So support to those, but also not just greening technologies, but businesses that need to green up. However you can support them in whatever ways they might need. They might not be very green at the moment, and they might not be producing green energy, but it might need that they need investment to support them in becoming green. And again, that's not something I know anything about, so I'm not going to pretend. Pamela, have you got anything on that front?
Well, I might just say Haringey does have a community energy company. It's called N-Tenergy, and it currently runs 4 solar arrays in the borough. So there's a possibility there of supporting that and making community buildings in particular could be self-sufficient in energy.
I will say is that because I belong to an organisation called UK Divest, they do have access to examples that you can use if you want more of that. Yeah. And I've put a link to their reports in the document that I will be sending you via email. Has all the links to all the different reports that, for those of you who want it. Yeah.
Do we have any other? Oh, Councillor Bevan.
Yeah, just to give perhaps a bit more background. So most of our investments now go through the London Civ, and for local projects like social housing, which the London Civ is working on at this very moment, and we are going to consider being part of, they're the only organisation that have the scale to do that for local councils, because local councils on their own don't have the capacity or the financial clout to deal with that. So we are working with London Civ, and London Civ on all their investments apply all the green standards that you talk about. So we are sort of heavily involved in the London Civ. And also there's a government report that was published, it might be the one you refer to, 2021, that requires all pension funds to meet certain green standards within a time span. Now, at the present time, this pension fund is not affected by that because it's not big enough. But as 1 or 2 years go by, the smaller funds will be involved. And I think we agreed that we need to try and align ourselves so that when it actually applies to us, that we are sort of more or less there. And then with local investments, it's not considered good practice for the fund to be investing in something in Haringey which could go wrong or end up with a conflict between the council and the local community group, whoever's running it. It's not considered good practice for that. So that's why any investments like that would be done through the London Civ, which could be much bigger. I mean, I do take your point about our future investment strategy, which we're working on now. We've had one meeting and we're working on that to apply for the next 3 years. And one of the things we said about that was we need to get a set of criteria, like there's United Nations codes and 3 tax charter marks and all that type of thing. We need to get them lined up so that every investment we make in future, we know what we're going to apply to it, rather than thinking, oh, should we apply this standard to it or this to that one? So we're working on that as part of our investment strategy. So I do agree with you, there's scope there. And with members' engagement, perhaps I shouldn't say this, but I do agree there's scope for much improvement on members' engagement.
I'm sorry, but that's the 15 minutes is up for the time spent with your deputation. Thank you so much for coming. It's very useful and helpful for us as a committee. And we will be providing you with a written response, a formal written response in due course.
Can I just say that I've done some photocopies of sort of what I said, plus the motion, so if anybody wants to take a paper copy home, they can. But I will be emailing to those of you who've got an email address on the website. I will email it to you with all the contacts, and otherwise it will go to Fiona. So for those of you who have private emails, contact her if you want to see it. Yeah, absolutely. Yeah.
That's great, thank you. So we go on to item 6, record of training undertaken since the last meeting. Do any members have any training to report?
I will send mine in tomorrow to be in the minutes of the meeting.
Okay. Anybody else? No? Okay, item 7, minutes, pages 3 to 10. Does anybody have any comments on the minutes of the meeting of the 22nd of November? This is the public minutes only at this point. Yes, Councillor Bailey.
Yeah, just one clarification. On the forward plan, item 13, it talks about putting training opportunities in the pension forward plan. And when I raised that, I was only really referring to the LGA, because the LGA runs several sessions every year. Because if you tried to put everything else in, you'd be a complete nightmare. So whether we should just clarify that that is the sessions that the LGA runs for councillors.
Okay.
Yeah, that sounds fine. I'm happy with that clarification, and we'll feed that back once the LGA have announced their latest round of trainings.
Okay. Go on to item 8, pension administration update. Can I now invite officers to introduce the report?
Good evening, everyone. I'll now go through the pension administration update. So there's 3 items to update you on tonight. The pension fund membership update on the numbers, the online member self-service portal update, and an update on the McLeod project. So the update on the membership numbers, they're wholly quite consistent. So the active members are somewhat similar. There's been an increase in pensioner members and the deferred members have gone down slightly. That's due to an ongoing data cleanse project we're doing at the moment. So transferring members out to the new funds that they now work for, and also members contacting the scheme to retire early, which is why the deferred members have gone down and the pension members have gone up. On the member self-service, so the Member Self-Service Portal, MSS, is basically a portal where members can go online, view and update their personal information, and they can run their own retirement estimates. So it kind of helps them with kind of more information at their fingertips to help with their retirement planning. So on point 6.4, the table shows the number of active members, the number of members who have signed up, and that percentage. As you can see, it has slightly increased. And that's because we have been going around to members doing drop-in sessions, to external satellite sites to try and get members signed up to the Member Self-Service Portal. We do hope to continue to increase the engagement and the sign-ups with kind of more one-to-one and drop-in sessions for the members. In table 6.7, it kind of shows the members who've accessed the portal within the last 7 days, last 30 days, last 2 months, and last 3 months. That's not a cumulative total. It's just like last 7 days, 42 members. Within the last 30 days, 116. So if you add them all together, it gives you the total members in the last 3 months. We don't have kind of direct impact on those numbers. That's kind of as and when a member wants to log in, run an estimate or change the details. So it's more kind of for information purposes. Moving on to the McLeod update. So we've given an update on this previously, but there has been kind of new guidance issued early March 2023. And this kind of is around the issues we're having, or all schemes are having with data collection, part of the project. So the guidance sets out the kind of option available to administrative authorities around what to do if there's employers who haven't responded or have responded and the data doesn't look quite right. So we're not confident it's accurate. So what that means is there's solutions in what we can do. So we can estimate the kind of part-time hours based on the final pay of the member, stuff like that. So the project at Haringey is continuing with Haywoods, our administration software provider. And at the moment, the data gathering stage, we've got response rate of around 45%. So the next step of the project is to analyze that data to assess how accurate it is. And we're going to upload that into the pension system to get kind of like a data score. So once we've got that score back, we can then assess the next step on what we're going to do with the outstanding outstanding employers. So yeah, I'd say that the next step will be the more complex step. So that's when we've got the data, we can then go into the actual calculation and doing the correction action, sort of retrospective correction to benefits, and that's kind of where the kind of main meat of the project lies. So once we kind of get to that stage, we'll give a next update at the next committee meeting. And that's it. Any questions?
Councillor Bevan.
Yeah, a couple of points. So on the chart at 6.4, have we put something in everybody's, well, they don't get pay slips now, do they? They check it online email. Have we attached something to the pay statement for each month that refers to this member self-service portal to increase awareness of it? Because that seems to me a completely cost-free option. Seems quite simple. So that's the question I'm asking. And then I'm a bit concerned about the 45% response rate to this McLeod thing, which seems quite low. And then the second point about McLeod, I'm really concerned about the complexity of sorting this out when you eventually start, because I understand it's quite horrendous, and I'm really concerned that you don't have the resources. Are you planning for the resources? And it's all quite complex. So can you give us an update and an assurance that you'll be able to deal with that issue when you actually commence what is needed?
Yeah, so on your first point about the information about member self-service on the pay slips, we don't actually at the moment do that, but we are looking at the kind of new starter journey, and in the kind of new starter paperwork, we'll be advertising member self-service to the members joining. We could look into maybe add on to the pay slip, but don't think that's something we can do, but we'll double check that for you. In regards to the 45% response rate on the McLeod, so in relation to other funds, we are probably more ahead than others because some haven't even started the data collection side of it, but the 45% is kind of after the data, we've chased it 6 times in some employers, so there's kind of little more we can do. And that's why the new guidance kind of sets out what employers and administrative authorities can do with the low response that they're kind of expecting to get. Because you have to think that the data we're requesting goes as far back as 2014, which is 9-10 years ago. So the payroll providers may have changed. They may no longer be an employer in their scheme. So there's kind of workarounds for that.
Councillor Inga Karen.
Thanks, Chair. Can I test that a little bit more, Jamie, if you don't mind? So the active member registrations on MSS is 1,028. That's sort of just over 16%. Now, what do you do for all current employees? Do they all get a paper copy of their salary, or is that all electronic? And are they all using MSS?
So yeah, any member not signed up to MSS can contact the pensions team for any information like estimates and stuff like that. So we still offer kind of support outside of that, but we do let them know when they ask for an estimate. We do kind of signpost them to the member self-service portal as well to let them know that it is there and available.
So do they not all have a login? I mean, the reason I ask you, maybe I ask the question in a different way. So I work in the NHS and all of us have something called My ESR. I don't know if you're familiar with that. That's a universal thing. We don't get paper statements of our salary. So I was just testing that. What do you all currently do? Do you have anything like that?
Yeah, so maybe I can come in on that, Councillor. I think so. Initially, when a member joins, what we're planning to do is to let them know of the member self-service, but then they have to go on and log on. So it doesn't automatically give you an account when you log on. So the issue that happens is normally when members have been around for the pension scheme for a long time, they don't tend to sign up to the service. What we're finding through the work we've been doing recently is a lot of members don't even know about the service. So we spent a lot of time last year, engaging with different parts of the council when they're doing I think there was in November, there was a Money Week workshop in the council, and we were really advertising the service as something that members can use to access their pension benefits. So the two approaches is if they have access to the member self-service, they can go on there and see their annual benefit statement, which is basically a summary of their pension record for the previous year. That's quite a separate process to the payroll function, which they do get through a separate portal, which is not the member self-service. So these are sort of two separate processes that are managed that way by the council. But what we're trying to do is actively increase that number of people who have access to the member self-service. But unfortunately, it does require members also being proactive and actually signing up to the software. For us, we see a lot of benefits for it. It reduces the workload on the team in terms of the queries they're fielding, but it also makes members much more aware of their pension benefits. So it's something that we will be doing as much as we can. Like James said, he's been out seeing different employers, just trying to make sure that everyone's aware that this is a service that's open to them as well.
And the resources, Tim, for this all this McLeod work?
Yes, thank you, Councillor Vivian. So just coming back onto the question of resources. So I think where we are in this stage is the regulations for McLeod or what it will require haven't been finalized. And I think this is something that we are monitoring quite closely. As Jamie mentioned, in March, there was additional information around what to do with this missing data, which again would have been a big piece of what the team would be undertaking in terms of chasing those employers and making sure that we had a high enough response rate. but now a lot of that work is now being dealt with this new regulation that says we can make estimates. A lot of the work as well will be done by the software providers, so we don't really require additional resources for that. But know that we will need a lot more resources in terms of even a technical expert just to deal with cloud cases. But until we are aware of what those regulations are, we wouldn't be able to know what level of resource we'll need. So like we've highlighted in, I think, section 13 of the 613 of this report, is we anticipate we will need that, but we'll provide that feedback to the Pensions Committee and Board in due case once we're more aware of what those resource requirements are.
Okay, so can we note the report? Sorry, Councillor Hyman.
And is it 45% of how many people overall? When you say 45% of have had a response?
Is that of employers or people?
That's of employers.
Employers. So we write to employers who are participating in the scheme, and we ask them to basically provide us with this information, because a lot of them are the ones who hold this data in terms of how much pay they've paid for people. Where McLeod is quite complicated is when it relates to people who've done part-time work or who've not been employed throughout the entire service. The only way we can access those records or that information is directly from the employer. So essentially 45% of employers in the scheme, I'm not sure the number off the top of my head, have responded in some way or form, and the remaining ones we keep on chasing them. I think 6 times you said?
Yeah.
And I think there is obviously, it's prudent to just assume that we'll never get 100%, but fortunately there's been this new guidance that's been issued as to how we deal with those cases where we have no response.
Okay, so can we now note the report and the information provided regarding the pension funds administration activities as set out in section 6 of the report? Yes. Thank you. Item 9, pension fund quarterly investment and performance update. Can I now invite officers to introduce the report? Thanks.
Thank you very much, Chair. I'll be introducing this, the quarterly investment and performance update. This is a regular update that we provide to this committee, which essentially is a summary of the investment performance over the quarter, and the particular reporting period is 31 December 2022, but also looks at the investment asset allocation. So there are just a few key things to highlight or to bring to members' attention. The first one is the value of the fund as at the 31st of December 2022, which was around 1.6 billion. That was relatively flat compared to the performance in September, so there wasn't much movement in terms of asset class, although throughout that period there was some significant volatility in different asset classes. So the chart below sort of highlights or demonstrates the performance over the different time periods from 3 months to 5 years, and it compares it to an index, which is the Haringey New Total Plan, which is essentially our asset allocation based on an index. I think going forward, this is probably something we would need to provide further information on in terms of comparing it to a different benchmark, and that might form part of the work that we'll do when we're setting new targets or setting investments that are written on the back of the actual evaluation that we've just had. The next bit, section 6.7, just the strategic asset allocation as of the 31st of December 2022. Again, this is for members' information in terms of the strategic asset allocation that was decided the last time we updated our investment strategy statement, and whether there are any deviations from that. There will be some deviations from time to time, particularly in asset classes that are illiquid. So something like private equity, you see there's a big variance in Pantheon's valuation of 3.31%, but that's mainly based on the market moves, as we've seen other asset classes underperform during that period. So that's just again for members' benefit, but there's we don't need to make any immediate asset allocation changes or any rebalancing based on the asset allocation that's been presented to you. In terms of the funding position update, we'll be hearing the final results from the evaluation from the actuaries, and that's something we plan on providing in greater detail in future meetings. This will be a point of just assessing the investment performance, as well as the liabilities, the variations over the next few periods, and it'll be something that will be part of this quarterly update going forward. And then again, for members' benefit, is just the percentage of assets we're invested currently in the London Civ, which is about 75%, which includes all the listed equity investments that are currently managed by Elgin. Again, this is something that we will be monitoring going forward. in terms of what next steps as part of the investment strategy review work that will be undertaken. So without really saying anything more, I don't know if there was any other comments or questions would like to be asked.
Thank you for the update. Conscious of the date of the report, and that's the regular schedule, but I'm also conscious a lot has happened in the first quarter of this year. Slightly unfair question, but is there any informal update you can provide about how the portfolio is performing?
Yes, so we had a brief discussion about this afternoon, so I think John Raisin would like to say a few points on some of the market volatility we've seen recently.
Yeah, I mean, I can not on this portfolio, but sort of world markets generally. Notwithstanding the news recently about Silicon Valley Bank and Credit Suisse in particular, world equity markets actually are higher. Well, they're higher closed last night than they were at the 31st of December. Also, government bonds have actually strengthened over that period as well. So if you look at this banking crisis, which could have turned extremely nasty actually, if you remember what happened in 2008 when Lehman Brothers went down, on this occasion, a bank in America, Silicon Valley Bank, one of the 20 biggest banks in America, had a run. Essentially, the depositors decided to take their money out. The bank had invested in long-term assets which they couldn't liquidate. Therefore, the Federal Reserve had to step in, and so did the US government. That did cause some slight eruption in equity markets, but not very big. And actually, it's come back up. This happened in mid-March. It was back up by yesterday. The sort of amalgamation or the collapse of Credit Suisse after 160 odd years, and then amalgamation into UBS over the weekend again, doesn't seem to phase markets. So despite what could have been a huge banking crisis, it doesn't seem to have moved the needle. It was interesting yesterday that Janet Yellen, the US Treasury Secretary, says that the US government stands behind small banks if depositors start trying to put a run on them. So clearly the US government, the US Federal Reserve are stepping right in to stop any banking crisis. So at the moment, as I say, world markets are actually higher last night than they were on the 31st of December, despite all this volatility. I think perhaps the world has learned a lot since Lehman Brothers went down and we saw their staff going out with cardboard boxes 12 years ago. Thank you.
And maybe just to add a few more points to that, I think there still remains quite a great deal of uncertainty. I think this week we're expecting a couple more decisions from the central banks in terms of what they do with rates, and that will obviously have an impact in terms of how markets react to that. But I think if anything, this sort of emphasizes the point of having a diversified portfolio and making sure that we're invested and we're spreading that risk across the portfolio. And as part of the review work that we'll be doing, I think it's worth for members to consider whether you feel that diversification that is currently in the portfolio is enough, or whether we need to make slightly different decisions on the back of this thing. So I think between now and probably our next meeting, there will be some further volatility, by something that we're consistently monitoring.
Yeah, I mean, Tim's right. I mean, the Federal Reserve meets today and tomorrow. If anything, what's happening in the banking sector will possibly hold them back. It might possibly hold back the Bank of England from going as far as they would. We'll have to wait and see. But it could possibly hold rates slightly lower than they would have been, but we'll see what they decide.
Have we got any other comments, questions? No. This item has also got some exempt information, and the recommendation will be considered in the exempt section of the meeting, although the item is just to note. We go on to item 10, External Audit Progress Report. And can I invite officers to introduce the report? Thank you.
Thank you, Chair. I'm happy to introduce the report. I am joined by David Eagles, who's the External Audit Partner at BDO. BDO are the audit firm that is charged with doing the external audits on the Council's and the Pension Fund Statement of Accounts. So this report provides an update to members on the Pension Fund Statement of Account audit of 31 March 2021. So members might recall that back in 2021, in December, or in November, BDO presented to the Pensions Committee and Board the audit plan for how they would undertake that audit. I think since then, there has been quite a number of challenges. So this progress report is really to provide an update on the progress that's been made and some of the outstanding work that still remains to be determined. So I think and I'm sure David will go this in further detail. There are details in the report around how that work has progressed, about some of the challenges that they faced, particularly on the complexities of just public sector accounting, but also on the regulatory requirements that are now required from the audit sector to be able to discharge these audits. It's probably worth saying that Haringey is not the only fund that finds themselves in this position. There are a lot of funds that are still behind on their audits, and it does appear to be generally a challenging environment at the moment. So in terms of the report, before I sort of hand over to David for further update, just a few key things to highlight. The first thing is to say that substantially a lot of the work on testing has been completed. There are still a few key areas that require further assurance from the auditors and further testing from both ourselves to provide them with the required evidence. So that work is still ongoing, and we are engaging with them quite regularly. In terms of the findings in the report, the high-level summary is basically based on the work that they've done to date. There isn't anything there that would result in a modification of an opinion, which basically means, with all the caveats, is at the moment, based on everything they've tested, there isn't anything that suggests that the accounts have been materially do not provide a true and fair view of the processes that currently the pension fund is involved in. There is, however, one material misstatement which has been identified, which is an 11.2 valuation differences. And this is due to mainly the timing difference between when we complete our statement of accounts, the draft version, and when the private markets sort of investors send through their audited version of the reports. Because of the complex nature of the work that they do, it does take them some time to be able to actually properly value those assets. And as such, it does mean that there can be a material difference between the value we include in our accounts and what the fund manager says at the end of the period. So this is something we do agree with this finding, and we've actually agreed to also change it and make the updated in the audited version of the reports. It's something that was also reflected in the statement of accounts for 31 March 2022. So I think on that note, I'll hand over to David for probably a more in-depth update of the progress that's been made so far.
Thank you very much, and good evening, everyone. Just a handful of pages to take you through in the report. As Tim said, it's a progress report. We are coming to the conclusion of the work, so when we have completed everything, we'll bring back an actual completion report, but this is, as Tim said, substantially complete. So the first page I wanted to take you to was page 33 of your pack. This refers to the materiality levels with which we use to drive the audit. We have basically an asset-based materiality, which is the 16 million shown on the left of the page. That's for looking at the asset statement. But then we use a smaller specific materiality of 2.3 million for the fund statement, which is basically where we're looking at contributions receivable and benefits payable. As Tim's mentioned, there's only one notable item. It is pretty common with pension funds that the information does come through after the cut-off for publishing accounts. So there's not a particular problem with the way anything Haringey has done, but we're just saying that there's more information that we are aware of now as part of the audit that was available at the point of close down. So not a problem, and something which is sort of fairly easily corrected. Moving on to the second item I wanted to highlight, which is on page 39 of the pack. It relates to assumptions which the actuary uses for calculation of the expected liabilities for the pension fund. We draw upon a report produced by PwC, commissioned by the National Audit Office, which all auditors are using as a basis for assessing the assumptions being made. With the exception of one item, all the assumptions statistics that were used in valuing the Haringey pension fund were within the ranges that PwC communicated. We have one area where there's a footnote explaining that it's slightly out of range, but there was an issue with information provided to PwC. We're yet to get confirmation from the NAO from PwC that is a verified position. But assuming that comes through, then we have no particular issues to raise on the assumptions. Moving on to the next page in respect to valuation of investments, this is where we refer to the issue I've just talked about in terms of the later information on the private equity investments. We had a capital investment statement which came through after the cut-off for preparing the account. So again, that's just referred to there. Moving on to page 45 of the pack. This is one of the areas where we are still completing work. We've completed our work on contribution testing for the main administering authority and scheduled bodies, but we need to do some work on admitted bodies, and we're having some discussions about how we access third-party information effectively from these admitted bodies rather than something which is held by the pension fund. So we're discussing the most sensible, practical way of doing that with Tim and his team. So once that's completed, then the whole of that area will be resolved and no particular issues coming out of it. Finally, in terms of the points on the report, if I could ask you to turn to page 63, which is the residual work to complete. It's a relatively short list, so hopefully that provides a bit of reassurance that we're nearly there. The first bullet point is just we've been given some information which we just need to work through and complete our testing on those areas. There may be some residual points coming out of that or further challenges, but it's coming, as I said, it's coming to a conclusion and not suggesting any particular problems. Second point is the actuary confirmation, which I've just talked about. Third point is, again, contribution testing I've just talked about. And then the final point is completion of our final quality review processes, a lot of which has already taken place. So as Tim said, we are coming to the conclusion. So what I would say is we are not far away from completing the audit of the pension fund. However, it's important to note for the committee that we cannot issue our opinion on that pension fund until we are also in a position to issue the opinion on the main council statement of accounts, because the pension fund accounts that we are giving the opinion on is part of that overall, and we cannot issue one without the other. Now, that is potentially a sort of subject for discussion at central government about disaggregating those two things to enable the pension fund to be signed off earlier. But as we currently stand, we can't do that. So in terms of the timing for completion, I think we're due to complete the work on the pension fund by sort of mid to late April. So that will be sort of ready and waiting. And then the final issue of the opinion will depend upon the completion timelines for the main accounts. And there are a few things to be dealt with there relating to some investment, some council house valuations, and also infrastructure, which is a national issue, which is holding up the signing of accounts. And Tim mentioned earlier on, Haringey is not alone in having 2021 accounts still not signed off, and this is infrastructure that has primarily driven that particular point. So as I said, we are nearing completion here. Very grateful for the support provided by Tim and his team in getting to where we are. Just a few things to finish off, and nothing coming out of the testing which suggests any significant issues. The one large item was, as we said, simply a timing issue. So I'm happy to take any questions on any other areas within the report that members may wish to raise, but otherwise, I said it's been a pretty clean audit.
Councillor Bevan.
So the 0321 accounts, what was the date when these accounts should have been completed, assuming there were not, for want of a better word, excuses? The second question is, are we also now working on the March 22 accounts now at the same time? And the last point I want to make, in paragraph 8.4, it refers to reporting to the pensions regulator when the accounts are not completed as required. Are we going to report the auditors to the pensions regulator?
I think the original date for completion of 2021 accounts was late 2021. But there have been a number of issues. I mean, I'm assuming members are aware of the national crisis in public sector audit, which has been going on for quite a number of years now, so that we, BDO, and all the other firms are in significant backlog because of a variety of different factors, not least of which is availability of appropriately qualified staff. But also there are factors in respect of the complexity of accounts, and not necessarily Haringey, but in certain cases where we have some real problems with audit trail that councils are simply not capable of producing with sufficient quality to enable an effective audit. So I note the word excuses. It's not an excuse. It's a fact of reality, and that's something which drove the government to conduct or commission Sir Tony Redmond to undertake a review of the whole situation to see how we could resolve matters. So there are a lot of things going on. And there are some particular issues in terms of infrastructure, which I mentioned earlier on, where it's required a change to the SIPFL-ASAC Code of Accounting Practice, and also the issue of a statutory instrument from the Department for Levelling Up and Housing and Communities. So some really serious issues that are being dealt with by BDO as auditors and the other firms as auditors, and also councils around the country. So some very significant issues, and that's led to, and if you want to see this on the PSAA website, some quite shocking statistics about the number of audits which are still outstanding, including going back to 2018, 19 and earlier years. So there's a very significant issue here in respect of that. So we are doing our best to get things completed. I presented the report earlier on with the list of outstanding issues. There's not many things to go. The critical driver is going to be the timing of the main council's accounts, and we still have some pretty serious issues to deal with in terms of the housing valuations, and also to deal with the local impact of the conclusions on infrastructure asset accounting. So that's I suppose our position in respect to that. Maybe officers may wish to comment on the other questions you raised.
So are you working on the 0322 accounts as well?
No, we are not. We're not working on the 22 accounts. We won't start on those until we've completed the 21 accounts.
Okay, Patrick, you want to say something?
Yes, I just wanted to clarify something here, and that is, it is actually the administering authority reporting itself to the regulator where there are breaches. So it's a self-reporting, really.
Mr. Raisin.
Yeah, I could be wrong here, but I don't believe the council has any duty to report itself to the regulator, because pensions regulator has no authority, as I understand it, in anything to do with the LGPS, apart from governance and administration and certain parts of governance. It certainly has no authority whatsoever in relation to investment issues, and I don't think it does necessarily also in terms of accounting. We have to remember the pensions regulator is very much tied up with private sector funds, and its authority over the public sector is, in my opinion, quite rightly very limited. Our responsibility is to the Department of Levelling Up, Housing and Communities, and they ultimately are the arbiters of the LGPS.
Councillor White.
Thanks, Chair. Yes, so these really rather significant delays that are happening to the audit of the accounts for the year ending 2021, are they, so we're being told that they're not specific to Haringey and not specific to BDO, but that these are affecting a lot of a lot of different funds and a lot of different areas in public sector accounts. So are these factors, are they going to affect future years, or are they specific to this specific year? Given that we're being told that the audit of the subsequent year can't start until this is complete, and then we are now rapidly approaching the end of a third financial year, are we looking at the delays getting ever longer, and we're in 5 years' time we'll be 3 years behind, in 10 years but time we'll be 7 years behind, or is this on the path to being resolved?
In terms of the position, there has been an extraordinary set of circumstances which have impacted in respect of this most recent round, or at least the most recent set of open sets of accounts. In Haringey's respect, that's the 2021, but there are other London boroughs where we are still working on the 1920 accounts for a variety of different sort of complicated reasons. So there are things which are, I suppose, regime general, things like the infrastructure asset issue for any authorities holding infrastructure, which will be, of course, Haringey and all other London boroughs and county councils. But there are some specific issues relating to valuations, which is a particular issue for Haringey, which we're having to work through. We have some concerns about the beacon valuation, so that council dwellings beacons valuation approach, which we need to work our way through, and some other issues with trail. So in terms of, are we going to be continuing to go backwards? Well, this year has also been complicated by a restructuring of the NHS, which has led to a structural change partway through the financial year, requiring 2 sets of audits. So the finite and scarce audit resources being spread quite thinly, and it is, to be quite candid, taking away from the ability to try and catch up, which is what all auditors are trying to do at the moment. Will it get worse? I'm very much hoping it won't. We are desperately trying to catch up with the situation, but what we really need is a clean run of things without other things coming through to put us off target. So I don't think we are going to be going backwards. We are all trying to go forwards to catch up, but it won't be an overnight situation, because there simply is no additional audit resource out there to throw at this position to try and turn it around.
Yeah, and I think just from an officer perspective, I think it is worth separating between the council audit and the pension fund audit. So certainly from the pension fund audit, I think we will be prepared to work as close as we can with the auditors to progress this as quickly as possible. There are some challenges for having too many outstanding audits in terms of how we do our day-to-day work. So we are meeting with them quite regularly to try and see if we can progress that as quickly as possible. And I think, like David mentioned, there are a lot of stuff that we were hoping to have finished by April. If that work is completed, then hopefully when we come to the next meeting, we can provide another update on how that's progressing and perhaps our approach for the 2022 tackling that audit. But for us, that's something that we take quite seriously, because the delays do affect the day-to-day work of actually running the fund.
Councillor Inke, Karen.
I have one question. While all this is going on, I can note that the fees is being increased all the time.
I think
is that due to the council? Or that
it is
because of BDO?
It is entirely due to the changes in audit expectations. And I would point out, I think it's important for members to appreciate that under the new framework contract, and BDO didn't bid for that, because we are trying to focus on catching up rather than sort of committing ourselves to more work and creating probably more problems. But the new contract has average multiples of fees. The new fees will be of the order of 2.5 to 3 times as much as they are as a sort of a scale fee. So things are being driven further because of quality expectations and scope of audit. There are new auditing standards which will kick in from 2022-23, There's something called ISA 315, which is a risk assessment auditing standard, which we have to comply with, and that will significantly increase the amount of work which auditors have to do. And of course, if we have to do that work, then there is an obvious consequence in terms of fees. So yes, it is going up. It's not driven by things the council's doing particularly, but it's driven by audit quality expectation.
I suppose I'll just have to add that we need to just kind of get clarity and just make sure that any additional fees aren't due to any of the lack of resources of kind of auditing the accounts. I think we just need assurance around that. And also just to add that the Section 151 is involved in conversations with yourself, David, as you know, to try and resolve this and progress this. So, it has been escalated and it's something that he's prioritising for sure.
Absolutely. I can assure you that the additional fees are not due to lack of resource. We only charge you for what we do.
Karen.
Thanks, Chair. I would like to ask a question with regards to the risk the council is taking in terms of delaying the audit by this period of time. And I would like to understand what that risk is and how we mitigate against that risk, and if this is on a risk register of some kind. Because it defeats the purpose to do an audit that is so significantly delayed. In this case, I think we are lucky. There's no significant issues that have been highlighted here. But what if the converse had happened, that actually there was a significant issue or a discrepancy? How would we resolve that?
Yes, so maybe I can go first, just in terms of the first few points around the risks. So there are a number of risks that just are included in terms of if you don't complete the audit in time. So, for example, the normal calendar of how we do our processes gets affected. So there's slippage. In between audits, people might leave. So you might not be able to get the appropriate evidence to justify how those working papers were created. So the longer that goes on, there are a lot of number issues that might be picked up. So you're right, we have identified this as one of the key risks in our risk register, which is presented today, maybe not the accounting side, but just the summary of it. And that's something that the best thing we can do at this point is to just work as closely as we can with the auditors to reduce that delay and catch up. For some of our processes last year, in terms of how we close the accounts, we've already identified some learnings in terms of the delay that was created, because at one point you're sort of doing some audit queries and you're closing the accounts. And this year, the deadline has been moved to the 31st of May, and that's something that we are targeting to make sure that we close our accounts by then. Then at least the work that's being done is just to do the audit rather than actually the financial operations of the organization. So we have reviewed on how last year went and how we'll be doing things slightly differently this year. But yeah, you're right to point out that there might be things around issues that happen and not picked up in time, and then it'll be too late. But that's something that the auditors would have to advise on when they get to doing that audit.
Do you have any other comments? So can I ask that we note the audit progress report prepared by the Pension Fund's external auditors, BDO, and appended as Appendix 1 to the report?
Can I ask that we add some words expressing our serious concerns on this issue, that the committee wishes to express its serious concerns and worries about this long-standing issue and the fact that it might actually get worse. Fiona, if you can bring up some legal words, or is it in order to do that?
So it can definitely be minuted. As this is just a noting report, it wouldn't really form part of the recommendations, but it can be noted in the minutes if you'd like it to be.
Councillor Hymas.
I note that as part of the constitutional review that's ongoing at the council, there are plans to create a separate audit committee. Would the responsibilities around pension audit remain with this committee, or would they move over to the audit committee?
Yes, the plans is that the in terms of the pension fund, it will remain here, and the main council would go to that audit committee. So the responsibility for approving this will still sit with the pensions committee on board in the new constitution.
Given the delays in audit, it may also be worth thinking about how we can coordinate with that committee if there are kind of ongoing delays on their side as well.
Yes, I think like David pointed earlier, is the work we can do in pensions is to complete the audits, but we will not be able to get the actual qualification or the opinion from the auditor until the main council is done. So indeed, the work that they're doing there is also being filtered through. But in terms of that decision for the fund, that's still raised with this body, that specific decision.
Yeah, Councillor Watt.
Thanks, Tim. Just on what you just said about the responsibility for the audit of the pension fund account remaining with this body, is that because that is required by law, or is it something that the council could choose to move over to the audit committee if it chose to do so?
I don't know if this is something, maybe I can defer to Patrick as the legal guidance on here, but I think in terms of decisions that were based primarily on the constitution at the time, and I know there's a discussion around changing that constitution, but I don't know whether there's a legal requirement.
Yeah, I mean, the pension decision is actually an executive, non-executive decision, which falls under full council under the constitution. So it's up to full council to decide whether that remains with the pension committee or not. So, and if it changes that, then obviously the constitution needs to change as well.
Mr. Raisin.
Yeah, could I just make a point? The issue of the council's accounts and the pension fund accounts essentially being one is under consideration by the government. Both the Scottish government and the Welsh government have completely separated the pension fund account from the general fund account, and that's because in general, the general fund accounts tend to hold up the pension fund accounts. Occasionally it's the other way around. We've heard here from the auditor that in the case of Haringey, it's probably the general fund that's holding up, and that's the case in most places. The Scheme Advisory Board chair wrote last year to the local government minister, and he has replied this year very positively in writing, saying that he is asking his officials now to look into separating out the pension fund account in England from the general fund account completely. So we'd have two separate accounts. So it might well be that it would end up here again, whatever, because it could well be that they're going to be separated out. And you know, speaking as an ex-151 officer, I think it would be a good idea to separate them out, because at least then most councils would get one or the other signed off quicker.
I've been asked by the committee clerk, your point, John, of course my brain's gone completely. Is it just going to be your point, or is it going to be the committee's going to agree that?
Well, I'd hope the committee would agree that we express our really serious concern as it is.
Yeah, committee decision. Comments? No. Okay.
So just on another part, would it be helpful for the committee to receive another update on this at the next meeting of the Pensions Committee and Board?
So can we then go on to item 11, Haringey Pension Fund final actuarial valuation results and funding strategy statement. Can I now invite officers to introduce the report?
Thank you, Chair. Yes, again, I will make some introductory remarks to this report, and then I'm going to defer to the actuaries who are here with us today to go through their report in greater detail. So this particular paper or this agenda item has got two parts to it. The first part is a summary of the evaluation exercise that we've just undertaken, which we've just come to a completion of. So the full report has been attached to this, which summarizes the findings of that of that report, and also some of the decisions in terms of the contribution rates that individual employers will be paying going forward. The second part of the report will look more on the funding strategy statement, which is a requirement for the fund to regularly review it and update it, and we often tend to update it in line with the actuarial valuation. There are a number of key things that have changed since the last time in terms of just in the world of local government pensions. So this particular review doesn't capture all those changes. What it in fact does is just summarizes the document to make it easier to read. But what we'll be undertaking over the next few weeks or over the next few months will be to updating some of those few projects, and we'll bring those to our attention as and when prepared to be agreed. So anytime we do a strategy review, we're required to consult our employers on that, so they're compliant with that. And then the Pensions Committee and Board has the responsibility to agree the new funding strategy statement, taking on board the views of the employers if we have received any. So in section 6.3 of the report is just highlighting the progress that we've made this year. Through the course of the year, we've been updating this table in terms of our progress, and now you can see that most of it is complete, by a few asterisks which are pending as presenting this to you this evening, and also the consultation on the funding strategy statement, which ended yesterday. The key things to highlight is on the whole, on the report is the contribution rates that members or that employers will be paying going forward have on the whole reduced. This is in part to do with the investment performance that's happened over the last few years, but also some of the assumptions that the actuary has advised this committee on previously that were taken on board in terms of coming with these contribution rates. So this is something we have consulted employers on. We've done an employer forum, and so far most employers are happy with it, but there are still a few that we need clarification on before the start of the new financial year. However, at this point, obviously these rates won't change. It's just we need them to be able to clarify that they're happy with them. In the report also, there's a summary of the funding position, which we did provide at the previous meeting. And again, that remains the same. There's been quite a good improvement since 2019. But again, looking forward, this is something we need to monitor to ensure that we're still staying in a healthy funding position. So with that said, I'll pass on, Chair, if that's okay, to one of the actuaries to provide a bit more of an update.
Okay, thank you very much. I'll talk to the valuation report part of this and then pause for any questions, so on, and then I'll hand over to Julie to talk to the funding strategy statement. There's a little bit of looking back, looking forward in here. So the valuation report is measuring things as at 31 March 2022, and then the funding strategy statement is the guide that the fund uses to engage with employers for the next 3 years as and when issues arise. On the valuation report, so I think it's very helpful occasionally just to pause and reflect on the whole purpose of this pension fund, and you'll see how different elements of the agenda sort of weave in to the operation of the fund. There are just over 25,000 members, as Jamie had mentioned in his report earlier, and the purpose of the fund is to make sure that the benefits that the LGPS regulations set out are paid in full and on time, all those members as and when they retire, and to their dependents as and when they die. And unlike most public sector schemes, the local government scheme, of which this fund is the, if you like, locally franchised example, the local government pension scheme actually has assets to pay the benefits. Okay, it's not that it's not like the civil service or NHS schemes and so forth. So those assets that are used to pay the benefits to all these 25,000 plus members, they come from, in essence, two sources. One is investment returns that the fund generates on its assets, and you'll hear other reports to do with their investments. And the second lever is the contributions that are paid in to the fund by members, but more so by employers. Come back to members at the end. And there are just over 50 employers in the fund. Obviously, the council makes up the vast majority, but there are around 50 other employers, academies, contractors, and so on. And we are monitoring the position of each one of those employers individually, so we can see their past membership, their funding position, and we can establish a funding plan for each of them. I'll come back to that in a second. And we carry out this analysis once every 3 years, and again in line with the regulations, to reset the employer contributions for the next 3 years. So the valuation that we're just completing will set contributions for the 3 years beginning 1st April 2023. And I want to say a few words about three different aspects: process, the whole fund funding level, and individual employer contribution rates. And I'll pause for questions. So first of all, on process, and as Tim has outlined in paragraph 6.3, the table there, it's a very substantial process undertaking this valuation. What you as a committee and board can take away from this is that you can be reassured the whole process will be done by the end of the month, which is in line with the LGPS regulations. All the things that need to be done have been done and more. There is a report, as Tim says, which is included in your papers and a part of it in the exempt part. You'll notice that there are some blanks, in particular the final appendix to do with the government actuary section 13 information. That's because we only found out from the government actuary a week or two ago what that information actually was, that now we've got to run around and put into it by the end of the month. So you can be assured you will have a fully compliant valuation done within regulatory timescales, meeting all regulatory requirements. Okay, so that's point number one on process. Point number two on the whole fund funding level, as outlined in paragraph 6.10, and as discussed at a previous meeting of this committee and board, you are in a much stronger position than you were at the time of the last valuation 3 years ago. Last time you were broadly evenly funded. Now you are 113% funded, measured on a consistent basis. And that is primarily because of the very strong investment returns that have been achieved by your officers working with the investment managers. And whilst it's too early to say how you compare against your peers, but we do advise roughly half the LGPS funds in the country, and the 3-year return that you achieved of 30% over the 3 years, it's given in the report. I mean, that is very much at the top end. So that's done better than a lot of other funds. So I would suggest you're still in a good position relative to your peers. And then the third point, as regards contribution rates, couple of points to make. One, we are setting a contribution rate for every single individual employer, and those are laid out in the rates and adjustment certificate, which is, there are a few blanks there. There's a few employers we're just finalising the details for, but those will be put in place from 1st April 23. The council rate in particular, we engaged with the council. We were able to carry out some modelling in advance that allowed us to discuss with the council what were appropriate contribution rates that were still suitably prudent for the fund. We were able to do that last summer. Okay, we were able to do that months ahead of other employers, and that was hopefully extremely helpful for the council in the delivery of its budgeting, delivery of services and so on. I said I would mention member contributions for the avoidance of doubt. That those individual members in the fund, their contribution rates are set by the LGPS regulations. Okay, they are not affected by this valuation at all. Now, those individual employer contribution rates are set in line with the funding strategy statement. I'll pass over in a minute to Julie to talk more about that, but I'll just pause there and ask if there are any questions at all.
Councillor Ingram.
Thank you very much. Very good. Can I ask a little bit about the primary rate of contribution? In the table here, I have it at 17.5%. It's on page 3 out of 6, I think page 71, under 6.5, table 6.5. What does that actually mean, and how is that in comparison to maybe other pension funds?
So under the regulations, we're calculating a total contribution, because in a sense, it's all about cash. The fund has to have the cash to pay benefits, and it has to have the cash coming in from the employers, amongst other things, in order to pay those. Regulations say to divide that contribution nominally between primary and secondary. Primary is the cost that we would place on, for those active members, how much would it cost to pay for the extra year's worth of benefit that they will accrue in the next year. Okay, so The cost of the LGPS is quite a generous scheme, which therefore places a cost on it. The employee contribution rate is nearly 6.5%, and the employer share, that's 17.5%. So that means in total there's a cost of just under 24% of pay. That's the cost of the current active members of the Haringey Fund to accrue one more year's worth of benefit in the next 12 months is roughly 24% of pay. Does that answer your question, Councillor?
Yes, thank you. That was clear. How does that compare? Is that the average? Yeah.
Sorry, I forgot about that other thing. It's similar to other funds that we're seeing. It's maybe slightly less because because of the nature of the fund's investment strategy. We think that the fund's investments are pulling a little bit more weight in the future, that they're delivering a bit more of that return than some other funds see, and therefore that brings down the primary a little bit, but not wildly out of line.
Councillor Bevan.
So the council for the next 3 years will be paying 17.5%. How does that compare with the last, if I've understood you correctly, how does that compare with the last 3 years? And now Homes for Haringey has come back into the council. Are those staff all now treated exactly the same? Because before there were different calculations for those employees.
So in the exempt part of the papers, and I won't quote the figure yet just because it would be referring to the exempt part, but it spells out what the council contribution rate would be for the next 3 years, specifically there. The 17.5 is just the cost of accrual before you allow for past service funding. The council pool now includes Homes for Haringey members, so there is a single contribution rate that encompasses council staff, Homes for Haringey staff, LEA schools. There is a single rate that applies to all of them. And the members' benefits are unaffected by what the employer contribution rate is, for the avoidance of doubt. Okay, so Homes for Haringey staff in particular will be accruing the exact same benefits now as they would have been previously. Does that answer your question, Councillor?
Am I incorrect when I say the council total contribution will be 17.5%? Because you seem to be saying there's something extra.
Yes, the total contribution rate, I feel slightly restricted because I'd be referring to something that's in the exempt part. But if you look on page 205 of your paper, on the top line, it quotes the contribution rate for the next 3 years for the council pool. The 17.5% is the fund average of if you were just accruing future benefits, ignoring the past service position. There's a bit of an additional contribution that the council is paying in relation to that.
Okay, so in the exempt part you can...
In the exempt part, yeah. Sorry, yeah. I feel slightly restricted in what I can say, but I can direct you to page 205 for the exact figures, if that helps.
We've got any other comments? This item has also got some exempt information, and the recommendation will be considered in the exempt section of the meeting.
Sorry, Councillor, say before we move on, I think there's another item on here on the funding strategy, which I think Julie would like to maybe point to some of the changes or what we might expect in the coming months.
Thank you very much. So the funding strategy statement is a document that, of course, the fund has had for many years. It's been required to do so. And the triennial valuation is an excellent natural point to review that funding strategy statement. For this valuation, the fund has gone a little bit further than in previous valuations and has reviewed that quite extensively. The review changes focus on a change in the structure of the statement, with emphasis on improving the readability and the usability of the document for its intended users, who are the employers that participate in the fund. We've worked quite closely, the actuaries have worked with the fund officers to make this document the best we think it can be in terms of how employers are going to be able to use that in particular. We've use the services of an external copywriter to try and make this in as plain language as possible. We understand that employers pensions can be very important to them. Obviously, it's a significant cost to them, but they're not always going to be pensions experts. We've really had an eye on making that as user-friendly for them as possible. So the funding strategy statement has been updated quite extensively in structure and in content, but it is still, of course, fit for purpose and meets all of the requirements that it has to do. It's fully compliant with the SIPFA guidance about how to draft a funding strategy statement. And we've been careful to check through that really carefully to make sure that that is all fully compliant on that side. And it also sets out clearly what the objectives are of the fund are when setting the funding strategy. Douglas spoke there about how good a position the fund is in currently in terms of having a really good funding level. And that refers to the past service funding position. And we want to protect that in the future. And the way we do that is by making sure that the fund is taking in an appropriate level of contributions from the employers. Of course, the employees is set by the regulations, so we have to make sure that the employers are paying an appropriate amount into the fund. So the objectives that are set out in the funding strategy are to maintain solvency, to take a prudent view of how much money needs to be collected in order for the fund to pay out all the benefits that have been promised. But to set those contributions efficiently, so to not take in too much now or backload it to have to take in too much later. We've also aimed for stability of contributions so that employers know what they're going to be paying now and in the future. They've got not certainty exactly, but some assurance that the fund is trying to maintain as much stability as is reasonable. Really, there's been no material change to the funding strategy itself. The review changes focus on how it looks. So there's nothing that's significantly different in the strategy now, apart from some updates in particular that have to be made in light of the evaluation that's just gone. We have to set assumptions, we have to look at the actuarial model that we use for that. So that is necessarily been some technical detail that's been updated. If you do want to look at the papers, you'll find that in Appendix D, where the report starts from page 108 onwards. Don't have the exact page number for Appendix D, but that's where all the really chunky technical detail is in there about how the assumptions are set. Thank you, page 132. And that's where most of the difficult bits are, if you like. The rest of the document we've tried to keep as clear and as straightforward as possible so that an employer now can look at the contents and see what their journey through their participation in the fund is going to be from joining the fund, from what contributions they're going to pay as they participate, and then possibly how they exit, about what rules the fund is going to apply for how much money the employer has to pay or how much they might receive. As Tim mentioned, the fund has some more work to do on policies, on specific policies that we might want to flesh out to really make sure that employers know exactly what the circumstances, what arrangements are going to be made for their own individual circumstances for things like exiting the fund or for having contributions reviewed between valuations. And these are some items that have been introduced in fairly recent times, and so they're still a developing area. The funding strategy statement is always a living document. This will not be the last we see of it. We don't just review it once and then leave it alone. It's continually kept up to date for any regulatory changes and in response to any specific circumstances that might come up for employers that participate in the fund that might throw up an issue of an unusual circumstance that the fund will want to adopt a policy and to think very carefully about how that employer is treated. So we've updated it already, we will continue to do so. But meantime, I'd be happy to answer any questions about the content or about the change in the structure or the format that you can see there.
Do you have any comments and questions?
Brown, thank you. What are you estimating as the net cash flow position as a percentage of the assets? So I can see the relationship between the two.
So say that again, you want to know what the
net cash flow in or out of the fund is as a percentage from the contributions in or out, as a percentage of the total fund. So I'm trying to get the dynamics of the cash relative to assets.
I think that's not a figure that we have to hand, unless others would know that. No, that's not something that would be part of that. I would say that the valuation report is that kind of backwards-looking thing. I think what you're describing there is maybe something to do with future cash flow modelling about the balance between the contributions that are coming in and the benefits that are going to be paid out, and how that's going to look in future. So I think that's something we could potentially discuss with officers and pick up in more detail if necessary.
Because I'd have thought you'd need that number in order to work out the discount rate. And the other thing in my mind is, since we were running a year behind, and I don't have the exact figures, but just trying to do this in my head, having got an assumed discount rate of 3.6 in order to keep to a 100% funding rate, and having now down something like 6 or 7% since March, we now the target rate has got to be something like 7 or 8%, isn't it?
That's one of the items we'll be looking at, is to carry out regular funding updates to see what the position is going to be. There's moving parts of this where the funding level is affected by the asset performance over the last year, but also by the future expectations. So there will be some offsetting of the two, but once we've carried out an update, we'll know what the snapshot figure is. But it is only ever going to be a snapshot. We're much more interested in, is the current strategy still appropriate? Are the contributions still okay as they are?
We are going to know exactly what the first year contribution rate is of a 3-year period, don't we?
Well, the actual employer contributions have already been, for the year that's just been, that would have been set by the previous valuation at 2019. There's always this lag year, kind of called the intervaluation year. So for the 2022 valuation, the new contribution rates come into effect from the 1st of April this year. So there is a 1-year lag between the valuation date and the new rates and adjustment certificate coming into effect. But the contributions that were expected to be paid over the last year have been built into the model to determine what we think the contributions needed to be from this year. So even though we were carrying out its valuation at 31st of March last year, we were already building in our expectations of the contributions for the year that's just been.
Well, it's not going to change much because there's a fairly small change in the contribution rates. So the net cash flow is going to be roughly the same.
You got any other questions or comments? No? So can we move on then to...
Sorry, Councillor, say before we move on, I think there is a recommendation for the committee to approve the funding strategy statement. I don't know whether you'd want to put that forward to the committee for approval. Oh, they are exempt. Oh, yeah.
I was advised that it should all be in the exempt.
My fault. Yeah, I didn't know there was a bit in the exempt part, but yes. Requirement to approve.
So we go on to item 12, which is the forward plan. Can I now invite officers to introduce the report?
Yes, thank you, Chair. I'm happy to introduce this report as well. So this again is a standing item that we bring forward to the Pensions Committee and Board for consideration, but also to get some views and sort of thoughts as to how the pension funds forward plan is developed over the next few months. So we have an appendix attached to this, which looks at the forward plan. So that's Appendix 1, and that looks at the work that we have currently scheduled to undertake over the next few Pensions Committee and Board meetings. So there is one change that we've made this time around, which I'd like to bring to members' attention, which is mainly on the investment strategy review process, which formed the discussion that we had with a group of members from the Pensions Committee and Board earlier this year around how we go about reviewing our investment strategy, also looking at prioritizing what work would be important and how that work is developed over the next few months. So this report initially just summarizes that process that we will be undertaking from reviewing the current strategy all the way through to implementing it and then monitoring it on an ongoing basis. So it's an all-encompassing detailed review of the work that we'll be undertaking over the next few months. What I have done from section 6.6, which I would welcome members' views on in terms of the forward plan going forward, is the priorities that have been identified based on the conversations that we've had earlier in this year. So essentially, there are three priorities. The first one, which probably feeds into the comments that we've heard just earlier around the cash flow requirement for the fund, the difference between the benefits that we're receiving, which we know have been increasing with higher levels of inflation, but also the contribution rates that will be effective from the 1st of April, which on a whole have reduced somewhat. So the fund will need to undertake some work to review whether there is a cash flow requirement, if so, how that big that gap is, and whether there is a strategy that we can deploy in order to make sure that those cash requirements are met when they're for due. As you know, we do pay pensions every month, so it'll be good to know that we have cash on hand so members are not concerned. The next bit will be really to do an overall investment objectives, which is more to set around discussions around the target return that we aim for. There could be a range of returns we could go for. They all have an impact on our future funding level, but I think that's something that the fund would need to, or the Pensions Committee and Board would need to agree that would effectively set the asset strategy going forward as well. As part of that work, as Councillor Bevan has mentioned earlier in the meeting, there is a requirement for us to revisit our responsible investment goals and objectives, particularly the criteria in terms of selecting managers, what would deem to be appropriate for the fund. So again, I'm proposing that this is something that we consider in the first half of this year and is agreed before we start doing any new manager selections going forward. And then the final bit is around agreeing the strategy statement, which will feature the strategic asset allocation. Any decisions we will make on that will be fed through as a part of the process of the first two steps, looking at our cash requirement, our long-term investment objective, and how we're going to monitor that and what kind of strategies we want to be invested in, and also how we continue to monitor managers in that space. So there are a few pieces of work that have been identified, particularly in reviewing our listed equities allocation, but also reviewing the private markets allocation in greater detail. So on that note, Chair, I would like to open it up for discussion and to get members' views on the proposed work plan, and if that's something that they might be minded to agree to.
Councillor Bevan.
Yeah, could we have a briefing on the pensions dashboard and how that will or will not affect the council?
Yes, we can certainly feed that through into the work plan on the pensions dashboard. I think we have already been doing some preliminary work, Jamie, on that, but we're happy to provide a briefing to this group as well. Is there any specific time, Councillor Bevan, you'd like that to be brought forward?
I think it's getting delayed because of the complexity of it all. So I'll leave it to you to decide when it's probably most appropriate.
Okay, yeah, we're happy to take that away and provide a briefing to members in due course.
Do you have any other comments? No? Councillor White?
That wasn't my comment. Just to note that in light of the deputation that we received earlier this evening, I can't see any specific mention of kind of climate goals within this investment strategy review, and I'd just like to note that I hope that would be a focus for those discussions, and that maybe that should be noted in the minutes that if members agree that should be a focus, one of the focuses of those discussions.
Yes, so it has been included, although it's rather nuanced. It falls under the umbrella of responsible investment, but yes, I'm happy for it to be more explicit, and that's the work we intend to bring forward to the committee and board's consideration.
Okay, the recommendations for this report are set out on page 137. To note and agree to the proposed key priorities identified in section 6 of the report regarding the investment strategy review work, to identify additional matters and training requirements for inclusion within the Pensions Committee and Board's forward plan. So can we note that and agree with the additional things from Councillor Bevan? Yes? Okay, thank you. We go on to item 13, risk register. Can I invite officers to introduce the report?
Yes, thank you, Chair. So yeah, again, this is a standing report we provide to the Pensions Committee and Board to assess the risks of the pension funds that are included in the current risk register. So at each meeting, we particularly focus on one key area because the risk register is rather long and comprehensive. So for this particular meeting, we've attached the investment risk just to invite your comments and any of the scoring, or if there's anything that you feel we might need to include in terms of mitigating actions going forward. There are a summary of the key risks in terms of the entire risk register that we have included in here in section 6.5. High inflation still remains a key consideration for the fund and its implication, but also, as we've heard earlier this evening, the delay of pension fund accounts, that's also still being shown on there, particularly with the requirement for the pension fund to have an audited annual report each year. And then the final bit is really on the increasing risk of a market downturn, which I think prior to when we wrote this report, it did seem as if that was decreasing based on the commentary we're hearing from the Chancellor, but also from the central banks, which were looking to perhaps slow down on their rate increases. Since we've obviously done this risk register, there has been a lot of significant activities that happened. We've seen a number of banks, like John Raisin mentioned earlier, but also the economic uncertainty going forward remains uncertain. So on that point, I think I'll probably be looking to revise that risk from amber back to red, but just sort of giving additional context as to why it was amber at the time of writing. Without anything else, I think that's the main points to bring to members' attention. But Chair, I'm happy for members to ask any questions or any comments on the risk register.
So, any questions or comments? Councillor Inga.
Thanks, Tim. I take the point you discussed about the banking crisis. I do think that is a risk, and I think that needs to be up there on the risk register because I think there's a lot of uncertainty, and I think it's too early, I think, to dismiss this as a one-off or maybe a two-off, because I think Credit Suisse is a 150-year-old bank. It's just a few years ago, it was the darling of the markets. So I really think this is a serious risk.
Yes, I'm happy to take that on board and reflect that in the risk register.
Any other comments? So shall we note the report, the risk register? And I'll move on to item 14, Local Authority Pension Fund Forum voting update. Can I invite officers to introduce the report?
Thank you, Chair. So yeah, this is the Local Authority Pension Fund update, which essentially looks at the engagement activities and voting activities of LAPF, who we discussed earlier this evening. LAPF do share a lot of their information, so this is really a condensed report of the work that they do, which is available on the website. And I'm not sure if all the members of the Pensions Committee and Board are signed up to LAPF, but if not, we can arrange for you to be included on that so that they can demonstrate, or you can be able to see some of the work that they're doing in more detail. So essentially, the high-level report is that they did undertake some engagements with 26 companies in 12 jurisdictions, and a lot of their engagement focused mainly on climate change resolution, which at times might involve writing a letter or actually meeting with executives at different companies to assess what their goals or what their objectives are in terms of setting a net zero target or a Paris aligned or climate related report. So in their quarterly updates, they will go into details around the engagement that they've actually done and whether that's been effective or not effective. In table 1, which is section 6.5, it also looks at the quarterly voting summary. This is again something we provide to members just for context in terms of some of the voting alerts that are issued by LAPF and also how the manager has voted for those resolutions. So that's again just a high level summary. There wasn't a lot of activity in the quarter, just those 2 voting recommendations which were forwarded to the to the investment manager, who voted on both occasions in line with the LAP recommendation.
So any comments? No, can we note the report then?